Hi everyone, today we're going to talk about the booming real estate market in India, investing in real estate and how rental income works for NRIs. The Indian economy has been on a steady growth trajectory for several decades now. Along with this growth, there has been a significant surge in the demand for both commercial as well as residential properties. Now this isn't surprising considering the potential of appreciation in property values and rental incomes. Now you as an NRI are no exception to the real estate fever. Initially you might have invested in properties for your own use or for your family. But the potential for good returns on real estate investments might have encouraged you to invest more funds into this asset class. Renting out a property in India can be quite an attractive proposition. However, it's not as simple as it might seem. There are a lot of aspects to consider, from selecting the right tenant to entering into a lease agreement, managing rent collection, property maintenance, and not to forget dealing with accounting and taxation matters. So in this video, we're going to highlight the essential factors that NRIs should keep in mind when renting out their property. We'll break it down under the following key areas. First, let's start with understanding who is an NRI. The next step is to understand if rental income is taxed and how it will be taxed. The third step is to understand TDS rules on rental income. What are the precautions the NRI and the tenant should take? Do we need to file tax returns and filing income tax returns? The last step is to look at other important provisions. So who is an NRI? Well, to understand who an NRI is, we need to consider Foreign Exchange Management Act, FEMA, and the rules for repatriating funds. Essentially, every NRI will eventually face the question of transferring their hard-earned income to their country of residence, whether for financial needs or for exploring other investments. And of course, investing in Indian property is often driven by the desire to earn a decent return. But here's the deal. Our conversation today revolves around income. So let's dig into how the Income Tax Act defines NRIs. In simple terms, NRIs are individuals who don't reside in India for a significant part of the year. The crucial section for this is Section 6 of the Income Tax Act, which provides some key criteria. To qualify as a non-resident, you should meet one of the following conditions. Condition 1, you should have stayed in India for a period less than 182 days in the previous year. Condition number 2, you should have stayed in India for a period less than 60 days during the previous year and for a period less than 365 days in the 4 years immediately preceding the relevant previous year. Now there's a twist. If you're leaving India for employment, business, profession, or as a crew member of Indian merchant ship, that 60-day condition becomes superfluous and it usually gets replaced with 182 days. But wait, there's more. For Indian citizens or persons of Indian origin residing in foreign countries but visiting India, the period of stay in condition 2 is also adjusted to 182 days. And here's the kicker. The Finance Bill of 2020 brought in another change. If your income in India is more than 15 lakhs during the previous year and you're not considered a tax resident in any other country, that 60-day condition magically turns into 120 days. So there it is. Your residential status is determined for the purpose of taxation. Alright, you've got your NRI status nailed down and now you're probably wondering, how in the world is my rental income going to be taxed in India? Well, let's break it down for you. Here's the deal. As a non-resident, you typically aren't liable to pay tax in India except for the income you receive within the country. This includes various forms of income like business income, property rental income, capital gains, salary, consultancy fees, dividends from Indian companies, and so on. Now, when it comes to calculating your tax liability as a non-resident, it's pretty much the same as for residents. You'll be liable to pay income tax as per the income tax slab prescribed in the budget. Now, these slabs determine how much tax you owe based on your income. There are two tax slabs you can choose from, the old one and the new one. You can opt for a slab that works better for you. But wait, don't stress just yet. The Income Tax Act offers some deductions to determine your taxable rental income and assess the tax dues. Now, these deductions include actual property tax payment, standard deduction of 30% towards upkeep and maintenance, home loan EMI, which can also be covered under Section 80C, interest payment on home loan up to 1.5 lakhs. Let's break it down with an example. Imagine you've rented out your apartment in Bangalore for a monthly rent of 45,000 rupees. You've dutifully paid your property tax of 12,000 per year and your home loan principal and interest for the year are 1.2 lakhs and 1.45 lakhs respectively. Now here's how your taxable income would be calculated. Rental income 45,000 per month into 12, which will be 5.4 lakhs, minus property tax paid of 12,000 rupees, minus 30% standard deduction will lead you to 1.58 lakhs. You know the best part? You don't have to show the expenses and maintain the books of accounts. This is the general deduction available to everyone. Minus home loan interest up to 2 lakh rupees, rupees 1.45 lakhs. You can avail this deduction under section 24B. The net taxable income from house property is 2.24 lakhs. On top of this, you also have paid 1.2 lakhs towards home loan principal repayment. Principal repayment is eligible for tax deduction under section 80C. This would reduce the overall taxable income to 1,04,600 with total taxable income less than 2.5 lakhs. You don't have to pay any tax. For you to use both deduction section 24B and 80C, you should opt for the old tax regime. But keep in mind, these calculations might change if you opt for the benefit of a lower tax rate under the new tax regime as specified in section 115 BAC. Next, let's delve into the world of section 195 of the Income Tax Act, which is pretty crucial for NRIs. This section is all about ensuring that tax is deducted at the source of income, whether it's interest, capital gains, rental payments, or even property sales. The goal here is to prevent any leakage of tax. So what does section 195 entail? First things first, if you're a tenant in India, you've got a role to play in this. Section 195 mandates that you as the tenant should deduct TDS at a rate of 30% plus a 4% cess. This adds up to a total TDS rate of 31.2% and this applies without exception regardless of the rent amount. Here's how the process works. The TDS amount should be deducted from the rental payment. Now, this deducted tax needs to be deposited into the government account by the 7th of the succeeding month. But that's not all. The tenant also has some quarterly responsibilities. They need to submit a quarterly TDS return in Form 27Q within a month from the end of the quarter. For instance, if they've made deductions for July, August and September 2023, they should submit the returns before 31st October 2023 as per Section 31A of the Income Tax Act. Now, as a tenant, you'll have to navigate a couple of websites. TI and NSTL website. Here you fill in the necessary details including challan details, verify and submit to obtain a PRN. This PRN is used to track and download the TDS statement. Traces website. You're also expected to download the TDS certificate known as Form 16A from the Traces website. This certificate is your proof of tax deduction and payment to the government. For the returns mentioned in the earlier example, the due date for TDS certificate is 15th of November 2023. Wait, there's more. You'll also need to submit Form 15CA online in the income tax portal every time rent is paid. Additionally, when the annual rent exceeds 5 lakhs, you should obtain Form 15CB from a chartered accountant, confirming that all taxes on the relevant income have been paid. Now, as an NRI property owner, you do have an option. You can apply to the Income Tax Assessment Officer in Form 13 to obtain a lower deduction certificate or an LDC under Section 197. This is particularly useful if your total income from India is less than the tax exemption limit. With this certificate, your tenant can deduct a lower TDS rate as specified in the certificate. But let's be clear, the process isn't a walk in the park, so be prepared for some paperwork and processes. That's a lot to take in, right? But it's all about ensuring that taxes are paid correctly and transparently. Renting out a property, whether you're a resident or a non-resident owner, comes with its own set of responsibilities and challenges. However, when you're a non-resident property owner, there are some additional considerations for both you as well as your tenant. Now let's explore these. As the owner, it's crucial to verify the background of your tenant. Now, this is especially important for absentee landlords who may not be able to visit the property very often. On the flip side, tenants should also be able to verify the ownership of the property to ensure they're dealing with the legitimate owner. Ensure that a legally sound rental agreement is drafted outlining all terms and conditions. It's vital to clearly mention your non-residential status as the owner in agreement. Both you as the NRI owner and the tenant should have a clear understanding of your respective taxation and TDS responsibilities. These details should be incorporated into the rental agreement to avoid any misunderstandings. Tenants should obtain their PAN and TAN well ahead of time. Now, these should preferably be included in the rental agreement to streamline TDS procedures. Tenants should remit the rent only after deducting the applicable TDS. Furthermore, it's crucial to ensure that the deducted TDS is deposited within the due date. Tenants should also submit the TDS return and generate quarterly TDS certificates. As the NRI property owner, you should collect and keep these certificates safe for submitting your returns. If the tenant fails to deduct TDS, it's important to note that this would attract interest at a rate of 1% for every month or part thereof from the date on which the tax was deductible. Even if the tenant does not deduct TDS, it's your responsibility as the NRI owner to report the rental income in your income tax return and pay the applicable taxes. These steps and responsibilities are essential to ensure a smooth and legally compliant renting process. Clear communication and understanding between both the parties can help avoid potential issues down the road. There's a common misconception among NRIs that they are exempt from income tax in India and that filing an income tax return is unnecessary. Let's clear this up. Your income in India is indeed taxable. So whether you're an NRI or a resident, it's essential to understand your tax obligations and ensure that you comply with them. Now let's talk about what you as an NRI property owner should do regarding your income in India. Number one, verify your rental income. Once your tenant has deducted the TDS and deposited it, it's your responsibility to confirm that all your incomes in India have been properly accounted for and the required tax has been paid. Regardless of your taxable income, it's wise to submit your tax return within the due date to maintain a clean financial record. Your tenant should provide you with quarterly TDS certificates in the form of Form 16A. By consolidating these certificates, you can arrive at the total rental income from your property. Next, calculate your taxable property income considering factors like property tax, standard deduction, and home loan interest as discussed earlier. Don't forget to include your other income sources, whether it's interest, dividends, capital gains, etc. Deduct any applicable deductions available in the Income Tax Act to arrive at your net taxable income. Your bank will provide you with a Form 16A for interest income and the associated TDS. Similarly, institutions will furnish certificates for TDS on any other payments. If your net taxable income after all the calculations and deductions falls below the basic exemption limit, the TDS deducted will be refunded to you. If you face a loss from a rented out house property due to factors like interest and standard deduction, you can carry forward such losses for up to 8 years. While you can submit your returns online, it's often a good idea to use the services of a chartered accountant. They can help you ensure that all your details are submitted correctly and on time, avoiding any omissions or mistakes. The last date for submitting your tax return is generally 31st of July after the close of the financial year. Filing your return on time is crucial to avoid penalties and to claim a refund of any excess TDS deducted during the year. So there you have it. Clearing the air about the tax responsibilities of NRIs, the importance of filing returns, and how to ensure everything is in order. Being an NRI property owner comes with its own unique set of challenges, especially when you cannot visit the property very frequently. Let's talk about some key considerations and strategies to make things work smoothly. Number one, tenant background verification. When you can't be there in person, it's vital to find a reliable tenant. Checking their background and credentials is a must to ensure a hassle-free rental experience. After your tenant deducts the TDS, the rent should be deposited in your NRO account unless your tenant is also an NRI. In that case, the funds can be transferred from their NRE account to your NRE account. All the TDS forms and return procedures remain applicable. Direct remittance to overseas account. If you don't have an account in India, you can opt for direct remittance of the rent to your overseas account. Your tenant will need to comply with all the bank formalities in addition to TDS and forms like 15CA and 15CB as applicable. You might be wondering if giving a power of attorney to a resident or Indian family member can simplify matters. However, this doesn't change the ownership status. The tenant is still required to deduct TDS and follow all formalities as long as the property owner is an NRI. Remember that your property income could be taxed in your country of residence as well. But if there's a DTAA in place, you can avoid double taxation. India has DTAA agreements with 86 countries and the rules can vary. So consult your chartered accountant to understand how DTAA applies to you and avoid paying tax in two places. If you own more than one residential property, only one will be considered self-occupied. The others will be deemed to be earning rent, and taxes will be applicable as per the income tax rules. You should plan for the regular maintenance and upkeep of your property in India, which should be available at any time. Consider hiring a reliable maintenance person or perhaps an agency to handle these tasks under your guidance rather than relying on your tenant. Ensure that your rental agreement clearly spells out the terms and conditions for the refund of the advance. This may include deductions for maintenance, damages, painting, and outstanding utility charges, etc. With a regular rental income credited to your NRO account, consider completing your KYC or Know Your Customer and explore investment opportunities. Starting a mutual fund SIP based on your risk profile can help your funds grow. Over time, rental rates tend to increase. You can consider using this rental hike as a top-up for your SIP to further boost the growth of your investment. The advance amount you receive from renting your property can also be invested in a fixed deposit to earn returns rather than leaving it lying there in your NRO account. By understanding these strategies and making informed choices, you can make the most of your NRI property ownership and ensure that your investments are growing as they should. In conclusion, renting out your property, whether you're an NRI or a resident, involves a myriad of considerations. From accountability to taxation, income tax returns to security deposits, and much more. Tenant screening and rent setting are also very crucial steps in this process. But here's the key takeaway. Seeking professional help from a chartered accountant can be a game changer. They can act as a bridge between you and your tenant, streamlining the entire process from tedious to filing income tax returns. This partnership can provide you with the peace of mind that you need, knowing that all your financial affairs are in good hands. So remember, informed decisions and professional support are your allies in making your property rental a successful and rewarding venture.